Hello, good afternoon, and welcome to HYCM's webinar. It's an FX week ahead, a live market analysis with myself, Giles Coughlin. Just want to say hello to folks as they're coming in, and if you could just let me know if you can hear me okay, that would be great. Hi, Anil, welcome. This is your first time. And Helen, good to have you back. Sammy and Van, great to have you guys. If you could just let me know in the question panel if you're hearing me okay and I'm coming through, that would be great. Let's see. I'm hoping I'm coming through okay. I'll just check my microphone. That seems to be okay from my end. Any problems and you can't hear me, just let me know. Otherwise, I'm assuming that you can hear me okay. Hi, Nadir. Welcome aboard. Good to have you. Yeah, thanks, Anil. That's great. Hi, Nadir. Okay, all the messages are coming through. Thanks, guys. Always like to have a bit of reassurance that you can hear me. Okay, we've got a busy week coming in. Just before we get going, just go through the disclaimer as normal, just to make it clear that this is not trading advice. The whole idea of this FX week ahead is so you look over my shoulder and you can see what is a professional trader looking at, and you can see the process I use to highlight interesting FX economic events that are coming up and potential opportunities that I'm looking for. And the idea is that you start to put some of these skills in practice yourself. So let's get cracking. It's a quiet week this week, really, in the markets. Volatility has been shrinking in the FX world. Next month in August tends to be the lowest volatility month coming up. So we're reaching a quieter summer trading periods with volume levels decrease in the FX world. People go on holiday, desks are closed for a break, so just to be aware of that. Now, however, having said that, we've got a couple of events that are significant. We have the Federal Reserve meeting the week after this, so next week at the end of July, and we have the ECB meeting, the European Central Bank, this week. So there's two big events that are likely to have a lot of volatility. So we're going to spend some time looking at those events, and we'll have a good look at the ECB meeting coming this week as we go through the details further. Before we do, I just want us to look back just to try to get a handle on what's happening with the US dollar at the moment. Now, it was 2 weeks ago when the Fed's chair Powell gave a very dovish outlook at the semi-annual testimony for the dollar. And going into that meeting, a 25 basis point cut was nearly 100% priced in for July. However, when Jay Powell came and spoke, he was seen as being a little bit more dovish. And then there were some other Fed speakers. I think it was Fed's Evans who came out the week after, the end of the week. And he said, started giving the idea that there was a possibility of a 50 basis point rate cut. And the market got very sort of excited about that and started selling off the US dollar. We've had a period of dollar selling. And the 50 basis point rate cut was seen as about 30% probability after Jay Powell's testimony. And that went down. I mean, last week, that went up rather. It was seen as a 50% chance of a 50 basis point rate cut seen for July. So that was, a big bump up in expectations. And so through last week, we saw that dollar selling coming into the market. And now, as is often in the market, we've done a 360. Is that the Federal Reserve blackout period has now entered. So the blackout period is a period of 10 days before the rate statement. So we've got the rate statement of July the 31st, and now this blackout period means you don't have any Federal Reserve speakers. So the Federal Reserve speakers aren't allowed to come out and give any indication of what's happening with the next rate cut. So the last message that the Fed has given is they've wanted to quite clearly dial back expectations of a 50 basis point cut. At the moment, they've indicated that there's going to be a rate cut in July. That is the expected outcome, nearly 100% probability seen as a 25 basis points rate cut. But the 50 basis points rate cut has been seen as the outlier, the unlikely event. And the Federal Reserve has just kind of underscored that. They don't want the market to think that a 50 basis point rate cut is coming. And that does make sense because the US economy is standing up quite well. You know, the US consumer is doing well. The inflation levels are not as bleak as everyone was expecting. So the general consumption output of the US is holding up. Jobs are doing well, earnings are doing well. So there isn't like a huge concern to cut rates. So the expectations and the economic data, you know, some would argue that there's no place to cut rates at all. It's only concerns about, you know, slowing global growth that are maybe seen as the reasons, just to kind of give it a bit of inoculation into the economy so it doesn't knock back heavily on any global growth concerns. So just looking here, you can see this is the target rate probabilities for the 31st of July Federal Reserve meeting. Now, we will cover this again next week for sure. But what I wanted to show it to you this week is that this probability rate cut or otherwise is moving the US dollar. Okay, so when that rate cut here, see, this is the rate cut at the moment. So this is 50 basis points rate cut. It's currently seen as, you know, around 25%. It's 24.5% probability. Now, last week that was up to 50%. So when it's seen as a more probable for the rate cut to be 50 basis points, we're seeing more US dollar selling. Remember that when we see an interest rate cut coming, that is bearish for the currency. When we see an interest rate hike coming, that's bullish for the currency. So what's happening here is that there's an expectation is only 25%. So that's why we've been seeing some dollar strength today. That's why we've seen the dollar index having a bit of a strength. So you can see here, dollar index, it's 97.21. It's increased from the open, and we're seeing the dollar index is just showing some US dollar strength, and that is why. Okay, so that's just to explain the position of the US dollar, just so you know what's happening. Now, I want to give you some tools as well. Okay, so one of the tools I want to give you is I want to show you how you can access this current target rate probability. And what I'm going to do is I'm going to send you a link. I'm just going to copy it here. I'm going to send this to you guys in your chat panel. Okay, so let me just send it there. Now this should go to all of you. Now, when you get that link, if you put that link in your web browser, I'll show you what I do. Hang on, let me just bring that across here. Put your link there, and then you'll get a page like this. And on the page, you will see that the target rate probability that's constantly updated, okay? This is constantly updated, so you'll get a sense of whether it's a 25 basis points or a 50 basis points target rate probability. And the greater that is, the more US dollar weakness we're going to be seeing. The lower that is, the more US dollar strength that we're likely to be seeing, okay? That's to do with the rate cut or hiking expectations. That's just a little tool. I hope you find that useful, and you can check up on the probability, you know, have a look at it, you know, session by session, as well as looking at the dollar index. Now, the other way to get a handle on the dollar is to use the dollar index. Now, I don't know if you guys are familiar with the dollar index, but it's basically it's a kind of a good tool to get a handle on what's happening with the US dollar. Okay, I'll just show you its ticker here. Let me just open up my. I'll just open up a page here, and we'll go to TradeView, and I'll show you the dollar index here. If you just go to TradeView, and if you just put ticker DXY, okay, that's the dollar index, and then the beauty about the dollar index is it will give you a snapshot, an indication of what's happening with the dollar. So you can see at a snapshot here, this is the 15-minute chart. You can see here from, you know, the open on the 20. We're opening here, we're opening 21st July, we can see that the dollar's been bid from the 97 handle roughly, reaching as high as 97.29, okay? So we see this slight dollar strength, and you can see into last week, You know, we saw this dollar weakness theme that was playing out, okay, knocking off that resistance level there. Okay, there's a couple of tools. Now, this US dollar currency index is the anti-euro US dollar pair. So the dollar index moves in the exact opposite direction to the euro US dollar pair, okay? So this is really helpful tool to get a handle on what's happening with the US dollar. Is it strengthening? Is it weakening? And it's a really handy tool to know what's happening with the euro US dollar pair. So if you're trading the euro US dollar pair, you want to have a look at the dollar index. Now, we haven't got time for it now, but go away, have a little play yourself, have a look at how the correlation between the dollar index and the euro US dollar chart is helpful, and you'll see that that's a helpful tool for you going forward. I just wanted to make that aware while we had it. Another little tool I wanted to give you guys is simply this, the intermarket correlation. Now, the reason I want to give you this today is because there aren't really many clear opportunities in the FX markets today. It's a very quiet day, volatility is low. There's, you know, the equity markets, yeah, they're down in the Asian session, but we're not really seeing a full-on risk-off trade. So the market's quite undecided. So at this kind of instance, we're looking for a fresh driver to enter the market. Now, sometimes intermarket correlations can help. Okay, so for example, you can take a screenshot of these correlations and see that when there's a lower volatility index, when you've got stocks rallying, commodities rising, bond prices falling, bond yields rising, then you've got a risk-on environment. Okay, so this is the characteristics of a risk-on environment. And then FX trades, we're looking at buying Australian dollar, buying New Zealand dollar, buying Canadian dollar, the commodity currencies. Okay. Conversely, when we get a higher volatility index, we've got stocks falling, commodities falling, bond prices falling, bond yields rising, and then we're risk off in FX trade. So risk off is when we're going to see yen strength, Swiss franc strength, and in the right circumstance, US dollar strength. So just to be aware of those correlations, it pays just to get them down in your head. And sometimes, as we've been seeing today, if you see a mixed picture, it's just telling you just pause. Okay, and just wait. So this morning in the London session, it was a good example. We had the Asian indices were down, the Hang Seng, the Shanghai Index, the Nikkei are all down, and typically you'd be seeing some yen strength in that environment, and there wasn't really much yen strength in the market, and it's just telling you that the market's kind of in an undecided mood. Okay, now it's a week ahead. What have we got? Well, some of the key events. Now, one of the key events for the British pound is Boris Johnson is expected to become the new Prime Minister. Okay, so votes are being closed today. He should be announced tomorrow. And what this means for the pound, it means not a lot for the pound, because the market is fully expecting Boris Johnson to be Prime Minister for the UK government. Just to remind you, if you're out of the loop, Theresa May has resigned, and Boris Johnson is a Conservative candidate, and he is currently winning and ahead in the polls for the new Prime Minister position. He's running against Jeremy Hunt, and Jeremy Hunt and Boris Johnson have quite similar outlooks. They both want to deliver a no-deal Brexit, although Jeremy Hunt is slightly more open to a delay. Boris Johnson is saying that October the 31st is the do or die day for Britain leaving the European Union. So that's why we're seeing some pound weakness this morning. It's just, you know, the market realizing that, you know, Boris is the front runner. Boris is likely to become British Prime Minister. Yeah, a no-deal Brexit is becoming more likely all the time. So what this means for the pound is, at the moment, this doesn't necessarily mean much for the pound. It's not going to be moving the markets when Boris Johnson is elected new Prime Minister tomorrow. That is not expected to be anything that's really of any interest or significance. However, the thing to be aware of with the pound at the moment is that the net short positions on the pound are very high. Last week's COP report was about 76,000 contracts short on the pound. So if we get anything positive for the pound, then the pound is going to see some immediate relief, and all those thousands and thousands of short contracts will have to be unwound. Okay, so that's tech traders and institutional funds. They will be removing those shorts if there's some positive news for the pound. So that would give, you would expect traders to be buying that change and buying from support. if that happens. Not relevant at the moment, but just to be aware if it does, the market is very, very short the pound. So any positive Brexit news will be very pound positive. That's something to be aware of. So in these quiet markets, it pays to be aware of, what would need to change to present an opportunity. This is one such event. Brexit, any positive Brexit news. There's more I could say about Brexit, but there isn't going to be much political meetings going on between now and September because UK Parliament is having a big break. And during that big break for the summer, there's not going to be much parliamentary news within the UK side of things. So the EU says they're not going to move, they're not going to budge. Boris Johnson says that he's going to make Britain leave Europe on the 31st of October. UK Parliament has prevented Boris Johnson, if he does become PM, from freezing Parliament to force through a no-deal Brexit. So at the moment, the highest probability is for there to be a general election. That is the highest probability now. Britain is facing a general election, and that, according to ING research, was seen as 35%. Okay, 35% chance of a general election. So that's just something to be aware of. That will cover that more in coming weeks. Okay, so looking into the actual economic data for the week ahead, there is not a whole load of detail coming out. I mean, these are a lot of minor, data reports, and I'm not expecting very much from these. The only thing to be aware of is the central bank speakers, Kuroda, and the Reserve Bank of Australia's Assistant Governor, Kent, speaking. Any indication on what the RBA are doing in terms of interest rates has the potential to move the Australian dollar. And again, anything that's pertaining to the Japanese, the Bank of Japan, their quantitative easing program, or their inflation records, or what they're planning to do in terms of addressing their stagflation economy, it could potentially move the yen. So just be aware of that. Not expecting much from either of them, but it just pays to be aware, especially when a central banker is speaking. On Tuesday, again, there's really not much detail coming out of there at all. Of course, CPI expected to remain very low for Bank of Japan. Now, Wednesday. Now, this is the first day that has some interest for me, and this is where we're getting the PMI data. This is the Purchasing Managers Index data out of France and Germany. Now, this is for risk for the euro. Now, the PMI data for the Eurozone has moved the euro before. Now, in the Eurozone countries, Germany is the largest member state of the European Union. So what that means is when data is released for Germany, it affects the euro disproportionately to other member states' releases because it's the biggest contributor to the whole GDP of the European Union. So pay careful attention to the manufacturing PMI data. Now remember, the day after this, we have the European Central Bank meeting. So there's a potential, if this data release here is very bad for Germany, if their manufacturing PMI is low, if their services PMI are low, and if France PMI services are low, then there's the potential for the euro to start selling off early from this point, okay? But it depends on negative data coming out for these releases. So that's one particular thing I'm looking at. I'm looking for potential sellers at this point if we get some weak PMI data. Now here is the data of the manufacturing, services and composite PMIs. You can see that they've been falling, and since 2019 these figures have been falling, particularly manufacturing PMIs. They've been falling. 50, above 50 is expansion, below 50 level is contraction, okay? So services and composite have been still in expansion, but the manufacturing PMI figures have been in contraction. And the reason for this has been the US-China global trade war. It's the concern over, hang on, Eslam, let me just see, you've got a question there. Right, Eslam, I'll address that question at the end. Okay, I'm just going to carry on for now, but I've acknowledged your question and I will address that at the end. Yeah, the PMI, manufacturing PMI has been low. It's US-China trade war affecting the Eurozone. Europe's a lot of trade with China. The slow manufacturing is seen as symptomatic and negative for the Euro. Big event, one to watch. You know, if you got some weak data here, you know, the last time we got some weak manufacturing PMI, I think it was 45, was a shock one for Germany, and we saw the euro sell off, you know, 100 or so points, if my memory serves me correctly. So Germany flash manufacturing PMI would be a sell that would likely be held into the press conference on the next day. Okay, so this is the last indication that the European Central Bank is going to get of the European economy before their monetary policy statement and refinancing rate. Now, the expectations for the ECB are quite straightforward and complicated, like always. Right, the straightforward bit is the ECB are expected to keep their rates on hold at 0.0%. However, they are expected to adjust their interest rates by cutting them to below zero between now and September. So it could either be at this meeting or September's meeting. I think I looked at the Reuters expectations, and Reuters have 62 of their 67 analysts looking for the deposit rate to be held at this current level. But 4 are looking for a 10 basis points cut, and 1 is looking for a 20 basis point cut. Okay, so the expectations are for that to be held. Now, obviously, if that rate cut comes, it's against market expectations, and you would see a sudden drop in the euro of around, you know, 80 to 100 points quite quickly, almost certainly. Now, what is in focus here is the policy statement, okay? And what market participants are looking for is how bearish are the European Central Bank? They're looking to see whether the central bank will indicate either like the extent of the packages to come. Is it going to be a quantitative easing program that's going to be released? Is it going to be a cut of interest rates? Or is it going to be a combination of both? Is there going to be a tiering system in terms of banks? So in other words, the problem is once you go to sub-zero interest rates, it means it costs you to leave money in the bank. Okay. Now, for many people, that's deeply unattractive, and many banks would be really opposed to charging their customers essentially for putting money in the bank. That's what it would mean. So one of the ways around that is this tiering system, and that means that, you know, only certain accounts would face charges for having money in the bank, but, you know, customers' accounts and general members of the population would be, you know, would not have to face that refinancing rate. So that's some of the solutions that the ECB could have. Now, in a recent article, the ING Investment Bank, what they did is they noted that the new ECB chief economist, this guy called Philip Lane, that he's clearly pointed to a package of stimulus rather than a sequence of smaller steps. Okay, so the risk here and the possibility is that the ECB commit to a package of things. You know, okay, we're going to start quantitative easing at such and such a date. We're going to be looking at cutting interest rates at, you know, the next meeting. We're also going to be looking at introducing a tiering system. You know, seeing something like that would be bearish for the euro. And remember that the Federal Reserve is going to be dovish at their July meeting, but the euro wants to be more dovish than the US dollar. So there's an incentive for the ECB to be more dovish than the Federal Reserve. Okay, so just to be aware of that. So the potential are weak services, manufacturing PMI, leading into a you know, dovish monetary policy statement. You can get that by following along on forexlive.com. You can also look at the ECB website, and also you have the ECB press conference afterwards. Don't see this as one event. See it as don't see it as one event here at 12:45 and forget the press conference. Because often, it's a learning point, when you get the monetary policy statement and the refinancing rate, often the press conference will have some more explanation as to what is actually meant. So, for example, if the market is very dovish, and at the press conference, they might want to dial back some of that dovishness. So just to be aware that the event should be seen as one rather than two. And so that's my main event for the week. That's what I'm looking at. And Eslam, how many pips would that affect the euro? If there was a surprise interest rate cut, you're looking at about 60 to 100 pips in the euro-US dollar very quickly. And if you get a sort of a more dovish outlook, again, it depends how dovish it would be. Yeah, Islam, that's how it would be. It would be on a interest rate cut, a surprise cut. Okay. Now, what you have to be aware of is the statement is as important as the financing rate in this instance. So if they said something like, we're going to cut interest rates by 0.10%, okay, the initial reaction is a sell. But say the monetary policy statement says, oh, but then we don't expect to do anything for ages, or we're not going to have any quantitative easing, we're not going to have any account tiering system. If there's something that is contradictory to that rate, you have to take it as a whole. Okay, Islam? So you've got to read into the detail. That's why it pays to read up and look in advance, so you can react when you see the detail happening. Okay, but a surprise interest rate cut would quite happily be 100 points to the downside. Whether that is maintained, you have to read the monetary policy statement. Okay. Obviously, euro-dollar core durable goods, they are out as well, and they're looking for a plus 0.8% headline. And there's been some orders have been down. Boeing has been really struck because of their their 737 Max model. They haven't been getting the orders in. We all know the tragedies that's happened with Boeing and the problems that they've been had. So there is a possibility that this figure comes in lower than the 0.2% on those risks. But again, the US dollar, look at what I already showed you. If you're looking to see how the market is taking the US data, come and look at the interest rate probability tool and see whether probabilities of 50 basis points are increasing or decreasing. That's going to be shifting the US dollar around. Okay. Now on Friday, we got the GDP figure. Again, that's a key data point and one to be aware of. But at the moment, I'm not expecting any huge changes or huge news from that, other than US's GDP staying buoyant. Okay, so that's what I'm looking at for this week. So guys, I hope that you see that. Zone in on the PMIs for the Europe, zone in on the ECB refinancing statement. And this is a good opportunity where it's just a good time to preserve your capital. I'm not in any trades at the moment. I'm just looking at the market, waiting for the next driver, the next thing to move it along, because you don't want to be entering into a trade and thinking, oh, I'm in drawdown, or I should be out the trade, I should be in the trade. No, just there's times when it's right to just be out of the market and just to wait for the next driver. And the next driver for me could easily be the PMI data or any Brexit related headlines that could come out. So you've got to be aware of that. Also be aware of the Canadian dollar, which I think I'll cover a bit tomorrow in the, we're running out of time for today's webinar. We'll cover that again tomorrow at 1 o'clock to 2 o'clock on the online trading workshop, which is with me again. Okay, we'll look at the Canadian dollar and the opportunities that are potentially there. Okay, so just a final offer to just make you aware of. There is an offer here of coaching with myself one-to-one. If you deposit $1,500 into the your own account, then you qualify for 1 hour coaching session with me. $3,000, you get 1 hour coaching session and 1 hour trading follow-up review. And $10,000, you get 2 hour coaching session and then 1 hour trading follow-up review and 1 week's VIP support. Basically send me emails and I can help comment on any trades that you're looking at. So again, don't forget the Telegram channel that we have as well, where I often release, some insights into the market that are going on. So if you're not already subscribed to the Telegram channel, speak to your account managers and get yourself signed up to that. Okay, guys, thank you very much. If there's any questions, there's a moment now for questions. Other than that, I hope to see you guys tomorrow at 1 o'clock to 2 o'clock. Okay, guys. Well, that's great. Yep, thanks, Nadia. That's super. Good to see you guys. Take care, Sammy, Van. Hope that helps, Aslam. Goodbye. Thank you, guys.